welcome to the fourth and last day of Delphi Economic Forum. It's 10th year. I think it will go 100 and even more. And I would like once more to thank the organizers for doing an excellent job, which is really tough to organize all this in a timely manner and in such a good way. So, what a better way to start your Saturday morning than discuss about the dynamics of monetary policy. And we have a very good panel to do that. I would like to thank them all very much. First of all, Megan Greene, an external member of the Monetary Policy Committee in the Bank of England at the UK. Good morning, Megan. Christos Hadjiemmanuil, an internal member of the Monetary Policy Council of the Bank of Greece, as well as a professor of international and European monetary and financial institutions at the highly esteemed University of Piraeus here in Greece. Good morning, Mr. Hadjiemmanuil. And last but not least, Anthimos Thomopoulos, the founder and CEO of Hellenic Finance Greece. So I think we can start before going straight into the monetary policy, which of course is very interesting, especially during these times to live in. I had a very interesting read with my breakfast today. This one here, the last issue of The Economist, entitled Ruination Day, How to Limit the Global Damage, and some interesting stuff in there, talking about Donald Trump's tariffs that will cause havoc. And I would like first to have a round discussion on this, if our guests today share this pessimistic view, if indeed they will cause havoc, if there's going to be a global damage, and how we can limit that. Megan, can we start with you?
Yeah, sure. First of all, I'm thrilled to be here again. I'm a veteran of the Greek crisis. You can tell from my accent I'm American, and I'm also on the Bank of England's MPC, and so I'm not sure which hat I'm ever supposed to wear when I'm here, the European one, the UK one, or the American one, but I'm going to try to wear them all, actually, particularly with respect to this question. We've seen in the markets over the past week that there's been a ton of volatility, and I think that is a reflection of kind of uncertainty around what is coming out of the White House. There are questions about kind of what strategy, global trading patterns, financial patterns, and that has caused volatility to spike pretty significantly. It makes forecasting really difficult, I'll say. So obviously the most pressing news over the past week has been with regards to tariffs coming out of the US. There are models you can use to try to figure out how tariffs propagate across economies. They tend to think that tariffs will be stagflationary for the US. Most models tend to assume that. For other countries, like a small open economy like the UK, it's not actually clear. So what does seem clear is that US tariffs are likely to drag on growth, and this is probably also the case for the EU. The implications for inflation, though, are somewhat ambiguous. So if you have export substitution, then you end up effectively having a big global demand shock, and that tends to push down on growth and inflation. If you have trade diversion also, so for example, China needs access to markets to export its goods. If it can't export them to the US, it might lower costs to find access to new markets. That's disinflationary. But the key channel really is exchange rates. And that's been really difficult because exchange rates haven't operated the past week as the models would suggest. So the dollar's fallen instead of appreciating as you would expect. So I think a lot comes down to whether you think that's a structural shift or just a temporary blip. But it certainly makes forecasting and figuring out how central banks should respond to this pretty difficult. Okay.
Mr. Hadjiemmanuil, on the same topic. First we're going to go on the macroeconomic and then we're going to go on the monetary.
I suppose that the past 3 months have essentially shook the post-war global trade patterns and the global trade regime. I don't think that there is any way to restore the status quo ante. We are now living in an entirely different environment, no matter what happens to the tariffs. The tariffs per se, the ones announced last week, are just one part of the equation. Accordingly, we now live in a much more uncertain global environment, and there is no question that we need to rethink and reorder our whole trade arrangements, production models, supply chains. And of course, this is a major shock to all economies, and the repercussions will be humongous, but as Megan was just saying, it is impossible to make predictions with any degree of accuracy. Accordingly, from a monetary perspective, one needs to tread very carefully, and the time horizons necessarily become much shorter, and the reaction to unfolding events will have to be more flexible and contingent. We have seen already that certain of the assumptions that we made just 1 month ago do no longer apply, the most significant one being precisely the one that Megan mentioned, namely that the intuitive reaction of markets to the announcement of the Trump tariffs did not materialize. If anything, the exact reverse happened, which, if you allow me to put it in a single sentence, makes life much more difficult for the American authorities and somewhat not pleasant, but easier to address from the perspective of Europeans.
Okay, Mr. Thomopoulos.
Yeah, I think I agree completely with what Christos just mentioned, that we're going through a uncharted territory. It's been, I don't know, 5 decades since we're living through a self-imposed stagflationary policy. The sure thing to kind of predict for 2025 is that the conditions bring monetary policy to the forefront of the debate, and obviously makes the life of central banks across the globe very much very difficult. I think they're going through a very tightrope situation. Completely agree. The reaction of the FX markets to the announced tariffs is really alarming, and questions put forward that what that means about the credibility of policy in the U.S. If it continues, it would spill over, really competitiveness issues about the EU and make monetary policy in the U.S. Really pretty difficult. I think in terms of the EU, which is where we live, it is an unfortunate coincidence that this fallout of the trade wars find the continent and the Eurozone in particular at sluggish growth, with very little growth to spare, which means that the impact of, we don't know really the impact, but the impact of the impending tariffs could shave off a few percentage points, few decimals of growth, but these are enough to put us into a recessionary area, and that again would put a burden on monetary authorities alongside fiscal to react to a worsening outlook. So in all in all, I think we need to stay calm, see how this thing pans out, but put forward a political debate ahead of monetary and fiscal reaction. I can only reiterate the optimistic signal that Prime Minister Mitsotakis mentioned a few days ago, that hopefully this 90-day hiatus will allow political rationale to prevail, and we may end up with a negotiated settlement, which in the end of the day may end up more sanguine than the current predictions. But from where we stand at the moment and the initial conditions in the EU, I think the situation on growth prospects in Europe are kind of challenging, to say the least, which on the other hand may make the monetary policy a little bit more easy in terms of decisions going forward in 2025.
So let's go to the monetary policy. I get the motto of Mr. Thomopoulos a bit, the UK-ish one, keep calm and carry on, but I don't know how calm we can be. Megan, let's start. We're going to go to the Bank of England, then to the ECB and to the Fed. Let's start with the Bank of England, how it's going to react to this new financial turmoil.
Yeah, so I'll start by highlighting that there's a lot of uncertainty. Also, it's interesting, last week we got US CPI data that actually surprised positively in that inflation came down a bit more than was expected. And the markets didn't react at all because it's old data effectively, and now we're in a new world to some degree. And it was the same for the UK. We got GDP growth figures for February surprised pretty significantly on the upside, but there is a question about whether that really reflects much given all of the change that we've been experiencing over the past week or two. So it is difficult to know. It's difficult to know kind of where this will land. We've had the imposition of tariffs, the delay of tariffs, the revocation of tariffs in some cases over the past couple of months. As a monetary policymaker, it takes a while for monetary policy to feed through the markets and into the real economy. Academics say it takes about 1.5 to 2 years. So when we're setting policy, we're setting it now for 1.5 to 2 years out. And so we have to have forecasts. But as I mentioned, our forecasts are pretty difficult, particularly when things are operating differently in the real world than they would in theory. And so in particular, exchange rates right now are tricky because you would expect the dollar to appreciate relative to other currencies if it imposes unilateral tariffs, but instead the dollar has dropped. It's also worth pointing out, I mentioned the UK is a small open economy, so we're not only affected by spillovers through trade and financial markets. If you look at the moves in the gilt curve, so our government bond curve, these days about half of them are driven by things that happen in the UK. The other half is driven by things that are happening outside the UK over which we have absolutely no control at a central bank, for example. And so our gilt curve has moved around just as the Treasury curve has moved around, and that affects financial conditions, so has to also affect our decisions as well. So we're considering the domestic data as it comes in. We have seen inflation come down towards our 2% target in the UK. We have a forecast that includes a near-term hump in inflation, but we don't expect that to last. The labor market has been loosening, but hasn't deteriorated significantly, but it has been easing. So generally, we think we're on track to hit our 2% target in the medium term, but tariffs will certainly have an impact on the economy, and how big is still a question. I think it depends what the end state is.
Okay, so now, Mr. Hadjiemmanuil, let's cross the English Channel and come to the EU. And on April 17, in a few days, the ECB meets. How should the European Central Bank, in your view, cut rates? Should it cut rates, and how fast?
Well, not for me to say, just to imply a couple of things.
I can take it.
Anthimos will answer that.
I'm not conflicted here.
But frankly, the key problem here is forecasting. Looking forward and setting interest rates, what exactly is your view of the months to come, of the years to come? Here, it is not only that we are not sure about the intensity of the shock, because this is a very major shock, but we don't even know how it will impact, in what direction it will impact the economy, because this is also state-dependent. Now, it has to be said more generally that forecasting has not been the strongest, how should I put, attribute of monetary policy making in Europe, and there has been a quite deep rethinking of how we go about relying on models that year in, year out are not absolutely accurate, etc. I think that in taking also into account the current developments, there is a clear shift in monetary policy making thinking at the European level away from medium-term forecasting or looking far ahead into the future, committing forward guidance and the rest, towards a more cautious, step-by-step approach. And this is quite evident both in the statements made by President Lagarde in her recent appearance before the European Parliament in the monetary dialogue, also in recent statements by Vice President de Guindos. I think then that the European Central Bank will be very cautious, focusing on different scenarios, how this could play out, and then it will be reacting month by month based on micro data, not only the standard statistics and models, also looking into each of all the alternative scenarios have materialized. Let me give you an example. Just 10 days ago, Vice President de Guindos was presenting the potential headwinds for the European economy and how inflation might go up. There was a fear that the tariff war and the trade problems might initially push inflation upwards at the same time that growth would decline by a few decimal points, also pushing the achievement of the 2% inflation target at the European level, say, a few months or 1 year back. But now, over 10 very short days, things look quite differently. Why? Because we have seen that the reaction of the markets has been consistently going against the dollar. We have seen since the beginning of the year a depreciation of the dollar, which rather than reversing has accelerated over the past few days. And what is truly amazing is the reaction of the bond markets, where you have seen the yields of the US Treasuries going up considerably, despite the fact that they had one issuance 3 days ago, which was quite successful and was taken up also by foreign investors. The question then becomes, why? Are we seeing some sort of market adjustment whereby people who are liquidity constrained had to liquidate positions? Is it just a rebalancing of portfolios, or is there something more substantial going on here, which is that suddenly American assets carry some sort of political risk premium, and there is a shift out of dollar assets and some sort of preventative rebalancing on the part of the major holders of US assets, including the Chinese, out of the dollar. Also in taking into account Secretary Bessent's and Mr. Miram's pronouncements to the effect that the US may take measures concerning the redemption of American debt, which is a very risky thing. If we are seeing such a thing, then suddenly the whole configuration for Europe changes. The likelihood now is that we'll see not an upshoot in inflation, that we'll see quite the reverse. Why? Energy is down, the US dollar is down, retaliation has not yet happened. Will it happen? This is a major question. And demand for European assets is not slackening. Also, the renminbi is falling, which is also a boon in terms of inflation. So now the situation is quite unlike 10 days ago. Now we're looking towards potentially a more pronounced hit on growth and less inflation, which makes, however, monetary policy easier, if you know what I mean.
Okay. Now let's see, Mr. Thomopoulos is, I think, the less constrained to speak openly about the ECB preferred policy action.
I can only echo what Christos very subtly put out. I think before the onslaught of the tariffs, one could say that the policy decision 17th of April was a close call. It's no longer a close call. I think we have so many deflationary contributors in the scene, which make it almost, a 60 to 80% probability that the ECB will cut. And let's move beyond 17th of April. The question for the policy in the Eurozone in 2025 is not where we will be looking cutting rates, is how fast and at what pace. So when and how much. It's not what it is. It's a one-way street. Just repeating summarizing what Christos just mentioned. Inflation has moderated. We're now, obviously, there are certain areas of concern in the last readings, especially service inflation, but core inflation has gone down. Energy prices are stabilizing. FX is dampening the impact of the tariffs. We should be more concerned towards avoiding recessionary pressures in the economy, especially even we have a modest tariffs that will save off a few decimal points of the very sluggish outlook of in growth in Eurozone, rather than the opposite. So I think I wouldn't be surprised, and this is, don't take it seriously, I'm a practitioner, I'm not an economist. I wouldn't be surprised if we see Euro crossing the policy rate, crossing the 2% level by the end of the year, depending on the duration and the scope of the tariffs if we end up with the tariffs. The surprise positive upside risk would only come out of a political settlement, would surprise everybody. I mean, if we had zero tariffs on all industrial goods in ECB, that would probably stabilize the policy rate at the levels that we were foreseeing before the onslaught of the tariffs. But otherwise, I think we're looking for an accommodative policy throughout 2025. In the typical ECB way of dealing with things, one obviously expects a data-driven policy. It's very difficult to forecast how these things will play out, but in the usual fashion, ECB will take action, pause, wait, examine data, and come back to the fore. We should anticipate at least 1 or 2 cuts further to the one that will happen on the 17th of April.
Okay. Now, Megan, I'm not going to ask you to comment on what Yannis Tournaras said at the FT, the Bank of Greece governor, but he did put a number there and said that the tariffs could reduce economic growth to the EU as much as 1 percentage point. Do you think that this could be the outcome?
So in fairness, I haven't done any of the modeling for the EU. I've only looked at it for the UK.
So what's your model prediction for the UK?
We're very different economies. So the UK is, like I said,
but
a
they're kind of
economy.
interconnected still.
The UK and the EU are interconnected. The EU is the UK's biggest trade partner in aggregate. So if the EU grows more slowly, that has knock-on effects for the UK, certainly. But generally, I think we can look at tariffs as a global demand shock, so that generally should sap demand, and that would push growth down. So I think, it seems like growth will go down. For me, the big question is what will happen to inflation. Generally, I think if you have export substitution and trade diversion, that tends to be disinflationary. Like I said, the question is exchange rates. So when you have unilateral tariffs from the US, normally you would expect the dollar to appreciate. That could actually boost inflation for other countries. As we've seen, the dollar's depreciated, and so that could be disinflationary. As the others have mentioned, if you have both growth and inflation going down, that's not an awkward position for a central bank. We know what to do then. If you have both growth and inflation going up, we know what to do then too. It's when they're going in opposite directions that you get into trade-off territory, and that's really tricky.
So, Mr. Hadjiemmanuil, during this turmoil, are the central banks under a lot of pressure that questions even their independence? For example, I would like to quote something that 1 week ago on the other side of the Atlantic, President Donald Trump wrote at his Truth social media. He wrote, and I quote this would be a perfect time for Fed Chairman Jerome Powell to cut interest rates. He's always late, but he could now change his image and quickly.
Now, you see, we tend to speak about the difficulties facing central bankers, but they are not all in the same position. Megan was rightly saying that this is a global demand shock, but from an American perspective, it's a supply shock, which makes it tremendously difficult, correct, for the American central bank to address the situation. Why? Because the supply shock is much more difficult to handle, and then again, the numbers go in opposite directions. You have a diminution of your growth prospects at the same time that you have an inflationary pressure because of the tariffs. Now, the Fed is truly in an unenviable position, both politically and economically, financially. In terms of how it should react, it faces significant dilemmas. Should it try to boost the American economy as President Trump might want it to do, but this would result in an upsurge in inflation at a moment when this is not clearly under control in the United States. Then again, politically, should the Fed yield to the president's pressure or insinuated guidance? Possibly yes. Why? Because the legal environment is different. Yes, there is a mandate, but the mandate of the Fed is different from the European one. And then the mandate there is legislative, while in Europe it is quasi-constitutional. It is written in explicit terms into the treaty. It is also a much narrower mandate. The ECB has to focus primarily on inflation, but this is a problem that will solve itself over the next few months. Is the independence of the ECB under threat or under attack? Not under attack, as far as I know, and definitely not under threat for practical reasons, because there is no tension between the political reactions and the central banking reactions. The one problem is the following. What happens if there are steep retaliatory tariffs and the tit for tat, whereby the United States increase? What happened with China, where suddenly you have a huge increase there? From a monetary perspective, it's preferable that you don't. From a political and from an economic perspective too, because this will dampen growth. From a political perspective, it may or may not be necessary, so this may pull in different directions. Let me add one thought on another potential headwind for the ECB. There was a fear that the German relaxation of the debt brake in combination with the new defense,
the Rearm Europe,
the Rearm Europe program, might add to inflationary pressures and prolong the normalization period. A very personal view on that. I think that people are getting hyper-excited. It won't happen so soon. You cannot mobilize the resources. The 800 billion will take ages to come to the market. There may be a psychological boost and better prospects for European armament companies and all the related industries and supply chains, all the ecosystem, but it won't play out immediately in terms of increased demand, other for certain investments. And then again, the German relaxation of the debt brake may also play a much slower role, if you want, than what we expect. If this is the case, I have to add something to what Anthimos was just saying, we have moved down from interest rates, policy rates of 4%. The ECB now focuses on the deposit facility rate rather than the main refinancing rate. So this is the indicator. It was 4% last year. It is already 2.50. Now you'll tell me this is significant relaxation of monetary policy, but it is still mildly restrictive. That is, despite the fall in interest rates. Remember this, the deposit facility rate is the bottom, is the floor of the corridor, and accordingly, the monetary policy stance is still slightly restrictive. If the ECB considers that we are moving fast towards a more recessionary or deflationary scenario, it is likely that it will reverse stance earlier than predicted and move into accommodating territory, which will validate what Anthimos was just saying.
Now, comment that, Mr. Thomopoulos, and at the end, I want
just a comment on, on this war of words.
Yeah.
Not being restricted or being able. I think I'll be quite blunt about it. I think it's a direct jab to the political dependence of the Fed. That's it's a revival of what we saw during Trump's first presidential term. Time and again pushing Jay Powell to cut rates. Now, this is strategic in my mind because it paints the monetary policy not as a technical reaction to employment and inflation data, but it paints it with a political imperative. By casting Powell as too late, I think he lays the groundwork for blaming Fed for being timid and indecisive if the economy falters. And I find that extremely risky because unlike ECB, where the political independence is warranted, I think, and strengthened by the day, I think we are moving into a very, very tricky territory if these things are nothing but just tweets. I would be very concerned. And now, how Fed reacts. Fed reacts the way it should react. It stays calm, data-driven, avoids escalation, doesn't get into the political debate. But on the other hand, this current administration has already dismissed 2 heads of federal agencies. And the Supreme Court kind of let it happen. So I can see paths that can really unnerve the markets if the administration decides to continue on that path.
Okay, so we have a bit of 8 minutes left. I would like to dedicate those 8 minutes to the Greek economy. And I want to start with Megan because I met Megan like 15 years ago, back in 2010, when she worked for the Economist Intelligence Unit. She was then in Athens trying to assess things about the Greek crisis that had just erupted. Now we can move 15 years later to now. How do you think things are going right now?
Sure. Well, so obviously the economy is doing better now than it was in 2010, for example. And I think a big input to that has been investment. That is the data point you can always point to these days in Greece and say, look, there's fundamental growth. I have a few concerns about that, though. A lot of the investment is real estate. That's a lot of foreign money coming in to buy up flats, Airbnb them in many cases. And so that's a cornerstone of the Greek economy now. And another cornerstone is tourism. And it's April. I was just in Athens. I can't even run on my running route. There are so many tourists around. It's only April. It's not even the tourist season. So I would say that only has so much room to run. Also, there are sort of climate sustainability issues around growing tourism forever. So I would argue that Greece still needs to find a sustainable growth model. There were some reforms implemented over the course of the crisis. There's one big one that I think is a real impediment to growth in Greece, and that's the judiciary. So not much has happened when it comes to the judiciary, and I think that keeps foreign businesses away. That keeps the hot money out, but I think it also keeps the stickier kind of FDI flows out. And so I don't hear much about that, but I think that's one area that Greece really needs to tackle before it does get foreign money in to help boost investment that's not just in real estate.
Well, if I may, I totally agree that the state of the judiciary is indeed the most significant structural problem. It has to be said that enforcement of claims has somehow accelerated and improved, both because of certain procedural reforms at the court level, but also because of the substantive rules which have relaxed the possibilities for enforcement. So there you may see some improvement. But let me second Megan on what she said about the need of reorientation of the Greek economy. Things are going very well for the moment, but there is always the risk of the economy overheating or being hit by external events because, of course, demand in Greece is to a very large extent sort of pro-cyclical, I mean, dependent on demand from the outside. And even though we are not directly exposed to American trade, we nonetheless are likely to face significant headwinds because of the situation. So an overheating situation coupled with then a sudden stop, that might be a problem. And I think that it is an urgent need for Greece to rethink not the headline numbers, growth, investment, but the direction of investment. We need, exactly as other countries, Germany for instance, we need to rethink our growth model. We cannot return, we should not return to the notice model of building apartments and basing all our growth on construction and this type of old-fashioned stuff. If you'll allow me, I know that you want to talk about Greece, but just one word on the global economy. We have been talking about monetary policy in classical interest rate-related terms, how the ECB or the Fed conduct monetary policy. But I think that the general geopolitical and geoeconomic reconfiguration forces us to think structurally as well. And this is also monetary policy. We need to think about the global monetary system and the dollar's exorbitant privilege. And we know that President Trump wants to keep the dollar relatively low, but at the same time retain the global predominance of the dollar, because this brings economic benefits to the US and political benefits because the dollar acts as a choke point for political reasons. There have been made threatening sounds about countries that would want to use other systems. But at least in one regard, the ECB should, not the ECB, I'm sorry, the European Union should move forward. It is high time to forget about antediluvian beliefs in certain member states where people love their cash and want to convince us that a digital euro is of no added value. And we need to think fast about launching a digital infrastructure for our monetary circulation, simply because at the other side of the Atlantic, they are promoting not only the dollar, but also stable coins, which have the dollar as reference. And this is a threat to our sovereignty, to our economic and political sovereignty. And we cannot live any longer with the rationalizations of tax evaders who claim that for reasons of privacy, we should always pay in cash. I believe in Rogov's belief that cash is a curse. is not a solution.
Okay, now you threw the bomb of the digital euro 2 minutes before the end. We did another 45 minutes for that only. We don't have that much of a time.
Fair enough.
Mr. Thomopoulos, the last word is yours on the Greek economy.
Look, I think obviously we've gone through a positive, very constructive patch over the last 5-6 years, which is obviously commendable. Still, I tend to agree with the comments of Christos and Megan. I think as a country we need to find a new model forward. There are a lot of headwinds ahead of us. We're so interconnected to the EU. EU is facing a sluggish outlook. We run the risk of being in a low inflation, low growth area. That doesn't bode well for a country that is dependent on tourism and trade with a weak partner. But I'd like to speak for something, just 1 minute, which is very close to my heart. Hellenic Finance is, for those that don't know, it's a private lending platform, the only private lending platform in this country to distressed credit. I heard in another panel a day ago that 15 years after the onslaught of the sovereign crisis, May 2010, this May will mark the 15th anniversary of that, we're still facing an 89 billion euros of distressed credit, distressed loans that were initiated before that crisis. They're still burdening 2.3 million economic units, households and businesses in a country of 4 million active population. And 15 years later, we stand with this problem unresolved, which is a major drag. It's a major drag to this country having a reasonable chance to go back to reach its growth potential. That calls for immediate active policy. And that policy, I think, is not on the private sector. Policy setters should go back to the drawing board and address a lingering problem which remains unresolved for almost 15 years now. And this is obviously an issue for another debate, but that debate must be had.
Thank you very much. Well, we're just 2 seconds before the end. I think this is a great. It has been a great conversation, and within the time limits of the Delphi Economic Forum. Thank you all very much for being here and for listening through the internet. Thank you very much, Megan, Christos, and Anthimos.